This is the first of a series of blogs on economic nationalism, a new trend which is facing countries worldwide. As emerging economies favoured building relations with like-minded countries through free trade agreements like MISA and the AFCFTA, they wanted to boost opportunity, investment and overall international trade. But now there's a growing realisation that developed nations are reversing that trend. So-called economic nationalism is being actively encouraged. Offensive use of tariffs rather than unbounded free trade, restricted rather than free movement of labour, and tight control on movement of funds across border, trying to prevent capital flight. By advocating these very protectionist policies and routes to self-sufficiency, there is a much more aggressive involvement by the state, is seen throughout many nations, often stifling entrepreneurial flair to satisfy nationalistic, isolationist policies. This thought process of trading with all, liberalisation and benefits for all is now being subjugated by a mantra that the economy should serve nationalist purposes only, not personal or corporate in the way it was in the past, and that was done by enabling the building of greater military power and national security. The whole concept of mercantilism in the construct of economic nationalism has never been more prevalent, designed to maximise exports, minimise your imports, change your flow of funds in and out, accumulating resources for a one-sided trade, one-sided benefit, and clearly anti-globalisation. In this scenario, international trade is not viewed as a win-win between nations or a meeting of minds. Is it a sharing of revenue? No. But where success, especially economic success, is only possible at the expense of other nations, other people's failures, or where the real aim is to achieve gains for yourself only. As with all nations suffering huge trade gaps, mercantilism aims to reduce a possible current account deficit, attempting to secure domestic funds and build reserves of finished goods for local markets through investment in international process and industrial processes. History shows us that such policies may have contributed to conflicts around the globe, with little agriculture in some economies or manufacturing capabilities. Countries then embark on aggressive foreign policy, embracing colonial expansion. The 16th century saw a rise of the East India Company, in its day the largest company in the world, accounting for over half of all world trade, with global influence and a value of more than $7.9 trillion in today's money. That makes it bigger than Google, Amazon, Microsoft put together. However, nations were already restricting trade, promoting tariffs, subsidies, and building domestic infrastructure with a view to creating the framework for long-term exports. Challenges of globalisation, economic inequality, security issues, limited raw materials were required in new technology industries, and political extremism and unrest are now unbounded. So that's what we're saying when we scroll forward from the 16th century to today. Very little has actually changed. Through tariffs, sanctions and blatant discrimination, the adoption of protectionist policies, these factors have created an ever-changing complex landscape that makes trade difficult, it's complex, it's bureaucratic, it's fraught with errors, fraud, corruption and many other factors which actually stop trading nations being as effective and economic as they could be. As a trade finance specialist bank, Exim Bank are positioned to enable working with emerging markets, looking at individual opportunities, all on a case-by-case basis. One size does not fit all. Ultimately, we provide a unique service, partnering with corporates and SMEs still prepared and required by necessity to navigate the choppy waters of international trade.